Your credit score in the United States is one of the most powerful numbers attached to your name. And if you're starting from zero, whether you just arrived in the country, just turned 18, or just never had a reason to interact with the credit system before, that number doesn't exist yet. And a credit score that doesn't exist is treated almost identically to a bad one. Apartments you can't rent, loans you can't get, interest rates that are twice what they should be. This video is about every legitimate path from zero to a real, working credit score. And at the end, the number that shows exactly how much a strong credit score is worth in cold, hard dollars over the course of a single loan. Let's start with how credit scores actually work, because you can't build something you don't understand. In the US, the dominant scoring model is the FICO score, which runs from 300 to 850. The score is calculated from 5 factors. Payment history is the biggest, 35% of your score, and it simply tracks whether you pay your bills on time. Credit utilization is 30%. This is how much of your available credit you're actually using at any given time. Length of credit history is 15%. How long your accounts have been open. Credit mix is 10%. Having a variety of account types like a credit card and a loan. And new credit inquiries are 10%. How recently and how often you've applied for new credit. When you're starting from zero, none of these categories exist yet. You haven't missed a payment because you've never had an account. You have no utilization because you have no credit limit. Your history length is 0 because there is no history. This is what's called being credit invisible. And according to the Consumer Financial Protection Bureau, roughly 26 million Americans are in this exact situation. The fastest and most reliable way to start building credit from zero is a secured credit card. A secured card requires you to put down a cash deposit, typically $200 to $500, which becomes your credit limit. You use the card like a normal credit card for everyday purchases, and you pay the full balance every month before the due date. The card issuer reports your payment activity to the 3 major credit bureaus, Equifax, Experian, and TransUnion. And over time, those on-time payments build your score. After 6 to 12 months of consistent use, you'll typically have enough history to qualify for an unsecured card, or see a meaningful score for the first time. 2 things to watch for with secured cards. First, some charge high annual fees or monthly maintenance fees. Avoid those because they eat into the small deposit you've already made. Look for cards with no annual fee or a fee under $40. Second, make sure the card reports to all 3 bureaus, not just 1 or 2. If it only reports to one, you're building an incomplete picture. The second method is becoming an authorized user on someone else's account. If you have a parent or trusted family member with a long-standing credit card account and a good payment history, they can add you as an authorized user. Once they do, that account's entire history, the age of the account, the payment record, the credit limit, gets added to your credit report. You don't even need to use the card or receive a physical copy of it. The account simply appears on your report and gives you an instant foundation that would otherwise take years to build from scratch. This is one of the fastest ways to go from credit invisible to having a real functional score. The catch is that it only works in your favor if the primary account holder has a clean payment history and low utilization. If the account has missed payments or is maxed out, being added as an authorized user will hurt you rather than help you. Choose carefully. The third method is a credit builder loan. This is a product specifically designed for people with no credit history, and it works backwards from a normal loan. Instead of receiving the money up front, the lender holds the loan amount in a locked savings account while you make fixed monthly payments over 6 to 24 months. Once you've made all the payments, you receive the money. The lender reports every payment to the credit bureaus along the way, building your history with each installment. Credit builder loans are typically offered by credit unions and community banks, and loan amounts usually range from $300 to $1,500. The practical benefit is that you're not just building credit, You're also saving money at the same time because at the end, you receive the full amount you paid in. The fourth method is a rent reporting service. If you pay rent every month and have been doing so reliably, that payment history is real evidence of financial responsibility. But it doesn't automatically show up on your credit report because landlords aren't required to report to the bureaus. Rent reporting services like Experian Boost, Rent Track, and similar products allow you to add your rent payment history to your credit report, sometimes going back 24 months. For someone with no other credit history, this can create a meaningful foundation out of something you're already doing and already paying for. Some services are free, others charge a small monthly fee. The fifth method is a student credit card for anyone who qualifies. If you're in college or university, student credit cards are specifically designed for people with limited or no credit history and are generally easier to get approved for than standard cards. They often come with lower credit limits and higher interest rates, but the same principle applies. Use it for small purchases, pay the full balance every month, and let the on-time payments build your score. Many student cards also offer modest rewards, like cash back on dining or subscriptions, making them genuinely useful for everyday spending. One thing nobody explains clearly enough is what can undo your progress just as fast as you built it. There are a handful of specific behaviors that disproportionately damage a young credit score, and avoiding them is just as important as the methods we've already covered. The first is missing a payment. A single missed payment, even by 1 day past the due date on a 30-day billing cycle, can drop your score by 50 to 100 points once it gets reported. For someone with a young, thin credit file, that's devastating. Set up autopay for at least the minimum payment on every account so you never miss a due date by accident, even if you intend to pay more manually. The second is maxing out a card. If you have a $500 credit limit and you spend $450 of it, your utilization is 90%, which signals to the scoring model that you're financially stretched and a higher lending risk. This can drop your score significantly even if you pay the balance in full every month, because the balance reported to the bureaus is often the balance on your statement closing date, not your payment date. If you're spending heavily on a secured card, consider paying the balance down mid-cycle before the statement closes. The third is applying for multiple new accounts in a short period. Each application triggers a hard inquiry that temporarily drops your score by a small amount, usually 5 to 10 points. 1 or 2 inquiries aren't a problem, but applying for several cards or loans within a few months signals urgency to lenders and compounds the score impact. Space out your applications and only apply for credit you actually need. The fourth is closing old accounts. Once you've had a secured card for a year or more and you upgrade to an unsecured card, the instinct is to close the old one. Don't. The age of your oldest account and the total amount of available credit both factor into your score. Closing an old account shortens your history and reduces your total credit limit, which can spike your utilization ratio overnight. Keep old accounts open, even if you barely use them. Regardless of which method or combination of methods you use, the rules for building credit are the same. Pay on time, every time. Even one missed payment can drop a young score significantly and stays on your report for 7 years. Keep your utilization low, ideally below 30% of your credit limit, and ideally below 10% if you're actively trying to build fast. Don't apply for too much credit at once. Each application creates a hard inquiry that temporarily lowers your score, and be patient. Credit building is measured in months and years, not days. Here's the number I promised you. On a $300,000 mortgage, the difference between a credit score of 620 and a credit score of 760 is approximately $80,000 in total interest paid over the life of a 30-year loan. That's not a small rounding error. That's $80,000, paid entirely because of a 3-digit number that could have been built with a $200 secured card deposit and 12 months of paying. A bill on time. The credit system in the U.S. is not forgiving of ignorance. but it is very forgiving of consistency. Start early, stay consistent, and the system will reward you in ways that compound for decades. You didn't get handed a credit score. You have to build it. Now you know exactly how. New video dropping soon. See you in the next one.